Guys, stablecoins, whether you believe it or not, is the best, and when I say best, I mean most profitable business model in crypto. And in this video, we're going to show you proof.
But before we get started on that, although I'm a licensed financial advisor, this is not financial advice.
All right, guys, so in this video, we're going to go over a brief history of money and stablecoins. We're going to cover the types of stablecoins. We're going to give you our thoughts on the future of stablecoins. And if you stick around to the end, we're going to show you guys undeniable numerical proof that stablecoins are the most profitable business model in all of crypto.
And also the most sustainable.
Yep. So without further ado, let's get into it, man. How you feeling?
Let's do it. Guys, I'm sure you noticed we're sitting right next to each other. I'm here now after a long journey. So your boys are excited. So I'm doing good, man. I'm doing good. How about you?
I can't complain, man. It's sunny outside. We're going to get a hike in later today. So yeah, let's dive into this video, man. This is going to be a good one, guys.
So I guess we'll start with the overarching philosophy around stablecoins. Now, back in 2017, when they started to gain a lot of traction, that's when you started to see initially that stablecoins would be used as an on-ramp for institutions or retail investors. But what it did is just allow them a more comfortable way to get in the market without experiencing volatility, scary volatility, not just volatility, but also it gives them a feel of participation. And so that was the initial philosophy. And also it would just allow institutions, basically what I just said, to be in the space without having or owning extremely volatile assets. And it's also on their books, it will be considered a cash equivalent because of the liquidity. So it's pretty universally beneficial for retail investors and institutions.
Yeah, and it's like if you look at the crypto ecosystem, in order to have a functioning financial system, you need borrowing and lending, you need insurance, you need derivatives, but you also need a currency to go back and forth between all of those things. So back in the day, it's crazy we can say back in the day because crypto's been around since 2009. There was no institutional or retail on-ramp. You were either in Bitcoin or you either had cash in the bank, and they were siloed off. So stablecoins allowed you to be in the market without being in the market, like JT said.
No, 100%, man. And, just kind of going back to the philosophy and what initially attracts institutions or just investors in general. So you got four prongs, right? So you got the low volatility trading. Vince, you kind of mentioned it. It's a medium of exchange. By the way, guys, if you've been watching our videos, I don't think Bitcoin is a good medium of exchange. A stablecoin is the
He thinks Bitcoin is shitty all around.
That's not true. I do think that it lacks inherent value outside of buying and selling and a store of value or escape from the TradFi system. But anyway, it makes perfect sense for a stablecoin to be an actual medium of exchange as well as a store of value as well as a unit of account. And so if you look at stablecoins relative to any other type of crypto blockchain project, stablecoins are what makes the ideal currency. It fits all three major prongs for a currency to fit. And then the last part, obviously you can generate yield on your stablecoins as well. So now you have the opportunity to invest in crypto with no to low volatility. You have a store of value to get out of the market, not completely. You also have an opportunity to get out of TradFi if you want. And also now you can generate yield, which we'll get into later in the video, on your stablecoins. So all around it's just a pretty good asset.
Currency.
It's like an asset in currency. I say asset because you can generate yield. And it's the same thing with like a US dollar. When you're generating yield on dollars, those dollars now become an asset. They're not just a currency. And so, because without it, they're just a liability. They're just losing value. And so now if you're generating yield, they become an asset as well as a currency. So that's why I said asset. So I guess we can move on to kind of like the history of money and kind of transition that into the history of stablecoins and go from there. All right, so I'm not going to give like a super detailed breakdown on the history of money because we've done it in like plenty of videos. We'll probably do it again, most likely. But I'll just start off by saying, look, money has been around for 5,000 years, probably longer, but just the first recorded form of money has been around for about 5,000 years. And it's crazy to me the lack of knowledge that we have as a society when it comes to money, even though it's at the basis of every decision we make, whether political, environmental, whatever it is. It's all about money. And so the first form of known money was the Mesopotamian shekel. It was about 5,000 years ago, as I just said, that's BC. in that first form of money, it wasn't really backed by anything. It was commodity money. And so the commodity itself was the money. So they used a shekel. And the shekel is made up of a few different pieces. I don't know every piece, but they have copper, they have gold, they have silver, all kind of mixed in one. So it's like a mixture of different commodities. They would turn them into coin form, and obviously they would use that as a currency or medium of exchange. And then the second form of currency that kind of we progressed to over time, so you had commodity money, and then you had asset-backed money, and so, or commodity-backed money. And so that's when we got on the gold standard, for example. Or, even back in the day, you could literally peg your note to any asset. I'm just going to stick to the US for this example, obviously. We pegged ours to gold. The second form of money, as I was mentioning, we went to commodity-backed money. So that's, for example, we were on the gold standard. Each dollar was pegged to gold at $35 an ounce, basically, right? Once we depegged from that, obviously now we've entered the third form of money, which is fiat, not backed by anything. It's valued by decree. It has value because our government says it has value. It accepts it as legal tender. And obviously that's how they pay their tax bill too. And so those are the three forms of money in a progressive way.
If you look at it from a logarithmic lens, if that makes sense, you kind of see stablecoins going through the same growing pains, evolutionary pains as currency did. So like back in the day, you had different banks issuing their own notes that were backed by gold. And you can kind of look at this as different forms of the dollar. Like you had the greenbacks. I don't know what the names of all the other banknotes were, but imagine how weird it is.
Federal Reserve notes was one of them.
Yeah, imagine how weird it is if in today's age, I go to Wells Fargo and then I make a withdrawal and I get a different kind of US dollar than I would get from Bank of America or JP Morgan or a credit union. So what ended up happening was eventually the Federal Reserve, they were established in 1914 or 13?
13. Fun fact, signed into office on December 23rd, 1913. That's the only day of the year where Congress has off, by the way.
Ooh, that's interesting. So yeah, the Federal Reserve was established in 1913. And then after that, the US dollar, which was the greenback, was declared legal tender. And what that means is that's what you have to pay your taxes in. So that made all the other currencies obsolete, all the other ones that the banks were issuing, because it's just like they would have to take those currencies and switch them to the greenback or now the dollar. And people were rushing to do it because eventually they know that no one's going to want to take those. Right. Because why would you? Because I can't use them to pay taxes. They're not as accepted in stores. So it's like now if you look at stablecoins.
And people were worried, sorry to cut you off, people were worried even during those times that their dollars weren't, or their notes, because they weren't dollars yet, their notes weren't being backed properly by gold. So they were worried at that time about the asset backing as well.
Yeah, so it's like now you kind of see that same thing happening with stablecoins. You got all the, how many, you looked up the stablecoins. How many did you say there were?
167.
167
That's according to CoinMarketCap. There's probably more.
Yeah, somebody probably just made one while we're making this video.
Literally.
So eventually,
I could think of one.
Eventually, as we're becoming more digital and you got CBDCs, which we're going to talk about a little bit later in the video, there is going to be, I believe, a stablecoin that's declared legal tender. And then all the other ones, people aren't going to care about them anymore. You're not going to see as much volume in decentralized exchanges, on regular exchanges, liquidity pools. Like, it's the same exact thing. And if I had to bet my money on which one I think it's going to be, I don't even have to say it.
I agree with that. So just so you guys know, there are three types of stablecoins primarily. Now, we might see some more in the future, but it's kind of hard to conceptualize right now. So the three types, you have crypto collateralized, and that could be under or over. So that's under collateralized or over collateralized. You have fiat collateralized, same thing, it could be under or over. And then you have non-collateralized or algorithmic. And so you could probably give a better example. The example I'm thinking of is Basis. I don't know if Basis is still around anymore, but they use a bond mechanism to determine the supply, basically, and it's just all algorithmic. There is no backing on that stablecoin whatsoever. I don't even know if they still exist.
Yeah, so it's like you actually see in the same parallels with the types of stablecoins. Like you have Maker, which issued the DAI stablecoin. And back in the day, or even still now, the only way to get DAI, so like all of the circulating DAI, came from people locking Ethereum into a vault and then withdrawing stablecoins, almost like an over-collateralized loan, withdrawing DAI from that vault. If you go on DeFi Llama, you can see that Maker is of the top TVL, and it makes sense because their stablecoin is so large. But now if you look at makers backings, they're holding a lot of like the same things that USDC and USDT is holding: short-term notes, treasury bonds, commercial paper, all these types of things. So like in the beginning, people are always like asset backed, gold backed, da 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 da. But they realize that that's just not a sustainable model, and you need an elastic currency, because that's the only way it can work, and that's the only way it has worked. And then in regards to algorithmic stablecoins, the logic behind that is the supply and demand controls the supply. So like, for example, we've all seen times where in the bull market, when things are going crazy, you see the price of stablecoins break its peg to the downside because the algorithm can't keep up with the volatility all the time. So people are selling. Remember, we said stablecoins are a way for people to get on-ramped into crypto. Once people are selling their stablecoins for altcoins or Bitcoin, you see the stablecoin drop because the supply increases. And then once people are buying stablecoins in bear markets, you see the price rise because people are buying them more.
And it's funny. So what you described, I think that would apply more to asset-backed stablecoins. I think with non-collateralized algorithmic coins or tokens, that response would be a lot faster because it is a coded monetary policy. So even if you think about how our monetary policy works as a nation, there's always going to be a lag. So in a asset-backed stablecoin where you have to rebalance, you have to, whatever you have to do, that's going to take some time.
Manual rebalancing.
Manual rebalancing, yes. Now, on an algorithmic stablecoin, I mean, anybody would safely assume that it's going to be a little more autonomous in the way monetary policy is carried out. And so decisions based on the algorithm should happen in a snap.
By the way, the decision that's being made, so in the bull market, when the price of the stablecoin would drop, in order to control the supply, the algorithm will burn the stablecoins. And when we're going to a bear market and people are buying stablecoins, the algorithm will mint new stablecoins to keep the peg.
Yep, 100%, 100%. And obviously the goal is to stay one-to-one with the assets, but that never really happens. It always breaks at some point. So yeah, those are the three types. Now, the first iteration of a stablecoin was actually BitUSD in 2014, and that was in July, not too long after you had Tether. But BitUSD was the first crypto-backed stablecoin. I can't remember exactly what crypto they held as a backing, but it's a reason it didn't work. The volatility is pretty insane if you're only backing it with crypto, and you can guarantee that they were extremely over collateralized, probably by 150, maybe even 200% back in the day, just to be safe. And so a couple months after that, obviously Tether, they were taking notes from those guys. Tether came out and they were more fiat backed. And so they use commercial paper, which we'll go through at some point here. They use commercial paper, they use dollars, they use treasuries, they use short-term bills. They use anything that is like cash equivalent or cash. So that way, they won't ever run into the issues that BitUSD has run into. And also, you don't have to over collateralize to own Tether because it's a one-to-one backing. So for me personally, like I've never been a fan of, well, I've been a fan, but I've never been a huge proponent of Maker and DAI, just because when you make it that complex, it's that complex for a reason. And when you have to over collateralize, that just introduces way more risk than, I mean, it doesn't make sense for you to choose that stablecoin over another stablecoin unless you're looking for yield generating opportunities specifically, and it happens to have a higher yield generation at that moment. That's the only time it makes sense. Other than that, if you're investing into any stablecoin trying to earn yield, and they're both kind of similar in the results or outcome, it makes sense to go for something a little more streamlined and a little more concrete in its makeup. Because you never know when it comes to coded monetary policy, something could happen to where there's a mass liquidation. You guys probably heard of network value settlement, which MakerDAO has implemented. So if that happened, which it hasn't happened yet, so that's good. But if that happened, it could wipe everyone out, it could liquidate without you knowing or wanting to. And it just introduced a whole swath of risk that me personally, I would like to stay away from. But that's just an opinion right there.
All right, guys, so now we've had the soup and salad. Let's get into the meat and potatoes. You stuck around to the end of the video. Now we're going to give our thoughts on the future of stablecoins, and then we're going to show you guys that numerical proof as to why we know that stablecoins are the most profitable business model in crypto. All right, guys, so here we are at cryptofees.info, and this website shows how much all the different blockchains, excluding stablecoins, making all of crypto. The 1-day fees, the 7-day fees. So you can see that Ethereum is the most profitable chain and the most profitable dApp in terms of fees and everything. Most of these projects are actually built on top of ETH. So you can see that in the last 24 hours, Ethereum made $19 million, $19.4 million in fees, and the 7-day average is around 19,390,000. So basically, when you're using ETH, whether if you're just sending a transaction and you pay a gas fee, and you remember you have EIP 1559 that's burning ETH on every transaction, you're swapping on a DEX, you're borrowing money on Aave, you're minting an NFT, these are all counted as fees to the Ethereum network. So you can see that 1 day, 19 million. So now, how do stablecoins have the best business model? So let's start with the smaller one, and then we'll go with Tether. So if you go to Circle's website, you can see what their backing is, right? So if we go here and we hit January 2024, and we go through this, you can see that a lot of their backing is US Treasuries, Treasury securities, right? And remember, Ethereum's daily fee was 19 million. They have more in their Circle Reserve Fund than all of the Ethereum fees. And when you're holding these treasuries, you're getting a yield on them. Like, you're not just holding them. All right, guys, so here we are on blackrock.com, and this is showing the Circle Reserve Fund. It shows the portfolio characteristics, the holdings. So you can look at this, and you can see 1 day yield, 5%, 7-day yield, 5%, 7-day yield, 5%. And then, guys, what you have to keep in mind is that when you go on Coinbase and you exchange your US dollars that you can get a yield by holding it in your savings account at your bank, albeit a shitty yield, when you take that and you go and buy USDC or mint USDC, whatever you want to call it, essentially what's happening is Circle is taking your US dollars and they're using it to buy these things that we're showing here, and they're getting a yield. And last time I checked, when I'm just holding USDC in my wallet, I'm not getting no kind of yield. So they're literally taking your money, getting a yield on it, not passing any of it on to you, and they're making a killing.
It used
low
to be
risk.
8.6% on BlockFi. But no, another important aspect too to point out here is the average maturity. So now, if this maturity, the average maturity was, let's say, even 60 days, I would be worried. The reason why is if you look at what happened with SVB, Silicon Valley Bank, what they did is they borrowed long and they lent short. And they're doing the opposite. Well, I guess not the opposite, but they're borrowing short, and they're also, I don't know if they're lending at all. I'm sure they're lending at some point, and I'm sure they're lending short. And the reason why it's important to have a short maturity or lifespan of these assets that you're holding is in the event that you need to rebalance, or in the event that you need to buy more assets. Obviously, that decreases the risk that you would have a run on the bank or a run on the stablecoin reserves, whatever you want to call it. So the average maturity is always important to look at if you're looking at any stablecoin holdings. And another thing to point out, which we'll probably see on this as well, is that most of these are cash equivalent. We've been talking about cash equivalent, and that means, they're investing into short-term treasuries. I think you actually just said this. They're investing in the short-term treasuries. They're heavily invested in the repo market. So the repo market, just so you guys don't know, so you got the reverse repo market, and then you got the repo market. So basically, it's just short-term borrowing and lending between institutions, banks, Federal Reserve. It's very short-term, literally overnight to maybe a couple days, right? And so they're generating 5% overnight on a lot of their funds. And then they have bills. Bills, just so you guys know, they don't go above 1 year. So whenever you hear a treasury bill, that's all of treasuries basically below 1 year. And so those are the longest dated assets that they have. I mean, they probably have shorter dated treasuries as well. And so USDC, they're in a good position. Even if they were lending right now, I would not be worried about like an SVB situation to where, they could become as a token or as a protocol, they could become insolvent because of their backings. They're doing a good job pretty much. Let me just put it that way.
Yeah, and guys, this is another thing to keep in mind. Remember a few months ago, I had just came off a cruise. This was about a year ago when USDC broke the peg.
Yeah.
It wasn't because they were mismanaging funds. I remember Jeff Bezos was talking about in the dot-com boom how the price of the Amazon stock was dropping crazy like a rock, but all the internal business KPIs were doing good.
Yeah.
This is a way you're able to verify it. Like, obviously, these audits come out on a monthly basis, so you can't keep a real-time estimate. But you can go on here and know that, they're getting a yield on all this stuff. They're not mismanaging their funds. But people get scared and they'll sell their USDC. And like we were talking about before with supply and demand, since it is an asset-backed stablecoin, it'll affect the price for a minute. And that's why when USDC dropped, I actually bought more USDC. How often is it that you can make
buy a stablecoin at
capital
discount
gains from a stablecoin? That's crazy.
And no, I just want to point out one last thing. So the last thing is that look at these maturity dates. This actually matures tomorrow, but you can see they're just going to reinvest. So yes, they introduce reinvestment risk when it comes to investing in treasuries, but once again, because it's short dated, that basically it just makes it a lot smoother process. So I really appreciate the way that they handle their backings, and they don't use a lot of commercial paper. Not a lot. They use some, but not a lot, which is great.
So guys, if we go on CoinGecko, you can see that USDC's market cap is 28.9 billion. Remember, ETH's one-day fees on average is around 19 million. So they're getting a yield on pretty much $30 billion.
5% yield on average at that.
And if we go here, guys, remember, interest rates are really high right now, so that's even better for them. You can see that most of their funds are in treasury repurchase agreements, and the rest are in the risk-free rate, U.S. treasuries.
Yeah, so that basically is just telling me that if something happened and they needed to raise liquidity super quick, they'll be fine. That's all that tells me. So they'll be good.
Yep.
Yeah, I just wanted to throw in real quick. So I think it's good to think about stablecoins kind of like banks because, okay, it's kind of like if you put your money in a stablecoin, you expect it to sit there. You expect, if you're looking for yield, you expect to earn a little yield. And they're basically engaging in fractional reserve banking. And so you can look at it as a bank. So the same dynamics that current banks have, and that's why I keep going back to SVB. If they had the same dynamics that a Silicon Valley bank had, where they owned a bunch of long-dated treasuries, and then most of their liquidity was based on short-term deposits, well, I would be extremely worried for USDC. And so, I like to look at them as banks because they are banks. And at the end of the day, if we do have any type of neo-banking, they're always going to be associated with some type of stablecoin.
Yep. So, guys, now that we went through USDC, let's look at the backings of USDT and talk about how they're even more profitable, even though people are thinking they're going to crash and burn. If they do, it'll be because of regulation, not because of how they're managing funds, at least in today's age. I don't know if I would have been able to say this a few years ago. All right, guys, so we're on tether.to, and you can look at their reports and their reserves. It also gives their breakdown. And remember, if you go to Tether, their market cap is pretty much 100 billion, right? 100 billion pretty much. Ethereum's, I have to keep saying this, one-day fees on average, 19 million. So we go here, you can see their reserves breakdown. Most of it is in cash or cash equivalent, aka short-term treasuries, corporate bonds, which is companies issuing bonds, precious metals, Bitcoin. Guys, you have to keep in mind, as Bitcoin is ballooning like crazy, I'm pretty sure that they rebalance their portfolio. Another reason why stablecoins have a great business model is because Tether only has like 30-something employees last time I checked. Like, they're not a huge company. So the few people there are making a killing. But as Bitcoin is rising like it has been, and they're rebalancing their holdings, they're able to take those guys, 2% of 100 billion is $2 billion. And Bitcoin is up, what, 100% in the past couple months? So they made just $2 billion alone on Bitcoin appreciation. So they rebalanced their portfolio. That's even more.
Just buy more cash equivalent.
Exactly. They're able to get even more yields. And it shows the ratio of what they're holding.
And also gives me, I was one of those people, I had my doubts about Tether because at one point, remember, they didn't disclose what backings they had. But obviously seeing this and seeing the cash equivalent, it's the same thing I just said about USDC. You see how small the cash and bank deposits are? I'm not worried that there would be a run on the reserves or run on this stablecoin because they have quality short-term debt that they could repurpose if needed very quickly. So I wouldn't be worried about this at all. I mean, they look good, to be honest. And the last point, I just want to hammer this home because I mentioned earlier how I like to think as stablecoin like banks. So also look at how much they have in money market funds. This right here, what you see at the bottom, for the most part, this is like bank breakdowns right here when it comes to their reserves. This is literally how it looks. So these guys are they're almost, as we grow and progress, they're just becoming more and more like a bank. Tether may be a bank one day. USDC Bank may be a thing. So I just like to think about it that way.
Yep, that's a good way to look at it. All right, let's check out their most recent independent audit. So this just gives you a more clear breakdown. So it shows you how much they have into what. So guys, if they're getting 5% on 63 billion, it's 3.1 billion. Remember, Ethereum is making 19 million and some change per day. They're making 3.1 billion off
in the safest way,
and off of not even their whole portfolio, just off of this 63 billion, this 1%. They're still making money from their Bitcoin, treasury bills, cash deposits, money market funds, precious metals, and their whatever other investment, whatever they got this other $3 billion at. Secure
other
loans.
investments. It tells you on the 14. I'm kind of curious. So it's some risky shit.
Yeah, it says here the other investments category compromises other investments by the group that do not meet any of the criteria set out in the other categories. So guys, stablecoins are making a killing.
Bro, they're basically operating like Apple already.
Guys, so that's undeniable proof that stablecoins are the most profitable business model in crypto. Now let's talk about the future of stablecoins. So the first thing I want to comment on is, like JT said, I think stablecoins are eventually going to become banks that are better for us, better and worse, because, you know, this whole CBCD narrative, they're going to have more eyes on us essentially, but we'll be able to get a better yield. And let me explain what I mean. Like, we always talk about real world assets and coming on chain. One of those things is the dollar, right? So eventually, I believe that just by holding a stablecoin is going to be like having a dollar deposit in a bank, to where they're going to be able to pass over some of that yield to you.
Bro, but on steroids, yeah, I agree.
And speaking of steroids, it's going to be able to increase your yield farming opportunities. Kind of like liquid staked ETH. If you want to go on Lido and you want to stake your Ethereum on the Beacon chain to secure the network, you go on Lido, you deposit, you know, they run the validators and all that stuff. All you do is get the yield minus their fees, obviously. But you're able to take that liquid staked derivative token and you're able to enter into different liquidity pools at low risk. Like, for example, you can enter into a liquid staked Lido, liquid staked ETH liquidity pool. You can have a tight range because it's a lower likelihood of it going out of range. One, because Lido has the top TVL. Two, because the prices mirror each other. So you're getting yield from just the liquid stake derivative token, and then by pairing it with another asset. So with stablecoins, it's going to offer that same opportunity where you're going to be getting a yield just holding your USDC. And now if you pair USDC ETH, you're going to be getting a double yield from the yield just holding a stablecoin and from inserting it into a liquidity pool. Because as more people start to wake up to the knowledge that we're sharing with you guys here, politicians, like, people are going to be lobbying for pass over some of the yield to the people. You got the wealth gap. Like, guys, it's only it's a matter of if.
I don't think it'll get that far, actually. I think because of the ethos of crypto, there will be an altruistic stablecoin builder. I wouldn't call any stablecoin builder altruistic at this point. They're all for themselves, which is okay. But I think there will be something that comes along, whether somebody makes a transition that currently exists or a new one, and that one of their whole ethos is to pass a large chunk of the yield that they generate, especially because they know they can sit in U.S. Treasuries and earn quality yield, and they can be confident that they can pass a consistent yield to their depositors or token buyers or token holders or stakers. They would be more open to passing even 3% to. Maybe 3% is pretty extensive, but they'll be able to pass a pretty good. It's actually crazy they're earning 5% on treasuries right now.
And guys, another thing I want to talk about in regards to the future of stablecoins, I want to talk about why institutions love stablecoins and why I think stablecoins could actually help the dollar. So starting with why institutions love stablecoins. Guys, did you know that if I want to send $1 billion from here to China, the quickest way for me to do it, other than a stablecoin, is to put the cash on a plane and fly it there, because people are using the SWIFT system. So stablecoins, since they're on a blockchain like Ethereum, they allow you to send a large amount for low fees and very, very secure. You don't have to worry about if it's going to get there safe. The SWIFT system, it takes a longer time. I'm not sure what the exact fees are, but stablecoins just make it way more efficient to, move money all around the world. Now, when it comes to...
And with SWIFT, you're not even sending money. You're sending like a message. So it's not even the actual money.
So now, in terms of stablecoins increasing the dollar strength, Guys, a lot of people in America are in crypto for the gains, but you have third world countries that are going through hyperinflation where their currency is better served to wipe their ass versus buying something at a store because it's worthless. All you need to get access to a stablecoin is access to a smartphone. You can set up a MetaMask wallet and you can buy Bitcoin and get some stablecoins. But in order to get access to US dollars, you have to be a US citizen, or you don't have to be a US citizen. It's just higher barriers to entry. A lot of banks don't go out into these places. So you have people that have to use their fucked currency versus being able to use a stablecoin. And you can get access to a stablecoin anywhere in the world. And currencies are just like assets, supply and demand. People always talk about like, oh, the United States wants to increase taxes so that the government can make more money. The government prints money. The taxes and raising and the rising and dropping of interest rates is just a way to control the supply and demand of the currency to keep it scarce. They have interest rates high because they're trying to suck money out of the system so they can increase the dollar's purchasing power. So by us having a stablecoin regulated, obviously this can't happen right now, and people being able to buy it across the world, that only means that more people are buying stablecoins, and eventually when the yields are being passed on, that's also like people buying more US treasuries. Our country is already in this super debt hole. That's going to help with that because there's more people holding our debt, because who wouldn't want to hold the US dollar, especially if it's a stablecoin? That's only going to help the United States.
Yeah, and I just want to insert a fun fact. The US dollar never gains in purchasing power. It kind of seems like it does if you look at the Dixie, but it doesn't work that way. The only thing the Fed does when it comes to manipulating the purchasing power is stop the rate of decline of purchasing power, aka disinflation. So we never go backward. We're not going to increase the purchasing power of the US dollar. We're just going to slow the pace of decline of purchasing power of the US dollar. Just want to throw that out there because it doesn't work like, oh, boop, boop, boop. No, our dollar's always going like this. Always. The thing that buffers us is what you said, people hold our debt. That buffers us a lot, so that increases the strength of the currency. Also, the fact that we're in a fiat dollar system. Also, the fact that we're the reserve currency.
Yeah, guys, now you got the two top dogs in USDC and Tether fighting against each other. Well, it's mainly USDC fighting against Tether. They're saying that they should be more transparent on their audits. So their audit report was pretty transparent, but why?
The other investments.
But why is it that they haven't had one since December 2023? It's March 3rd.
I didn't even catch that, guys. That's pretty old. I'm gonna be honest.
It's March 3rd, so it should be a little more up to date. And you think it would. Bitcoin's been rising. I know that their holdings had to rise more. Yeah. Actually, I know it did because on the 2023 it was like 96 billion, but on CoinMarketCap we're at 99 billion. So that's an extra $3 billion. So
probably all from Bitcoin gains.
USDC is just trying to steal the show and be the top dog.
Their government coin.
Pretty much, their government coin. But hey, only time will tell. If USDC is declared legal tender, if USDC is declared a legal tender and USDT is not, it could be a little different because actually I don't know. I don't know what will happen in that scenario.
I don't think any of them would ever be declared legal tender. I think that as a government, obviously we're the US, we want control. Everyone knows that. I'm not even trying to be conspiratorial, but we're gonna try to do it in a way that makes sense, right? So CBDC will obviously be the legal tender. I think what is undecided is the logistics in terms of how it will be carried out. Are they going to use other stablecoins as a conduit or other banks as a conduit? Is it going to be more direct? That's what we need to figure out. And then all those questions will kind of be answered, but I don't think they've even figured that out yet. So
damn, bro. I think we just made the best stablecoin video on the internet. Good shit.
I agree, man. Hey, guys. If this provided you some value, if it helped increase your understanding of stablecoins and the overall landscape, leave a like. Seriously comment because we want to know your thoughts. Tell your friends, tell your auntie, tell your daddy, tell your mama.
Guys, also, subscribe to our newsletter. It's probably live by the time you're watching this video right now. We're going to be giving you alpha on the stock market, bond markets, crypto markets,
real estate,
crypto regulation. Like, we're going to be looking at the overall economy and translating that into digestible information so that we can help you convert that information into strong portfolios.
Which is what macroeconomics is at its basis.
Yep. And we'll also be giving you our buy and sell calls. Like, you'll get access to things before we release it on the internet. So definitely subscribe to the newsletter. We have a free version, but if you want to get access to everything, Just $11 a month right now.
$11 a month, guys.
Yep. So with that, hey, we thank you guys for tuning in. Let us know what video you want us to make next, and we'll see y'all in the next one.
See you on the previous video. Say, nah.